again, glad to have everybody on a little quieter Friday, a little reprieve from the selling lately. And so let's jump in. I'm going to go over maybe 3 or 4 strategies, just talk about a few different things. If you guys have any comments, feel free to throw it in here. I'll start with, as I bring up here a chart, this is a 1-year price chart of SPX. And you can see here, I'm kind of highlighting this downtrend in the SPX that has started since January 4th. How many of you have been on Earth over the last 4 months and are aware we've been in a downtrend over the last 4 months? How many are aware of that? How many have been maybe in a different, maybe in Pluto or somewhere, and they're not aware of that we've been in? And how many are aware that this is the biggest or the longest downtrend most of us can remember? How many are aware of that this is like 4.5 months that we've been in a downtrend? And I think psychologically, isn't it pretty wearing for most of you, because you've never gone through this and you're not used to the downside, you're not used to the maybe speed of it, and you were spoiled by the market going up, or if it ever did go down, it'd go down to 2% and come back up, or go down 4%. But most of you, I would imagine, are tired of this. Yes, no? And let me ask a question. Option trading. How has trading been going? Ask a purposeful question. How has trading been going? And he says, love bear markets, rough, brand new, good for me, good, spotty, sucks. Now, let me ask a question. When I ask a question like, how is option trading going? Do I have any idea what the heck you guys are doing? If you say good or bad or spotty, in other words, do I have any idea what that means to Carl or Jody or Chris? I have no idea, right? No, I don't know what you're doing, right? Right? I don't know, and when I say the word option trading to Joe or Mike or Jack or Richard, could that mean something different, right? Yeah, and we'd say mostly due to the whiplash, but even that doesn't mean as much, right? Because how many know what David Dorgan, when he says mostly stop to the whiplash, how many are aware of what David Dorgan is doing? Is there anybody here that knows what David Dorgan is doing? No. So what I'm going to do is start out here, kind of break down, and we'll talk about this together. What kind of how we look at this whole options portfolio, and hopefully this will be a little bit of encouragement to you, because I remember whenever I had problems as a kid, my grandmother was the one raising us a lot. Not raising, but I mean, she was in the home, right? My Irish grandmother from Ireland. My dad was a Chicago policeman. My mother was an emergency room nurse, and they were gone a lot of the time. I remember when my grandmother, even my mother, if there was a problem, you know what they would say? That too will pass, right? How many feel like when you're in the middle of this downtrend, teetering on a bear market, that it will last the rest of your life? When you're in the middle of something, doesn't it feel like that? It'll just last forever, right? It won't, right? Right? It won't. But when you're going through it, yeah, now when Richard says he's seen this movie before, is Richard correct? Yes or no? Has he seen a 4-month movie like this before? What's the answer? No, I don't. I mean, I don't. if I asked Richard, show me, when you say, and I'm joking here, but show me when's the last time you saw a 4.5 month downtrend, right? What would be the answer? I don't know. When was the last time we've had a 4.5 month downtrend, right? I don't think 2009 was 4.5 months. I could be wrong. The COVID correction kind of bottomed after 5 weeks, but the bottom line is it's not that often. So I think as you go through any market situation or problem, I think perspective helps, doesn't it? Now, so, one thing I'm going to jump into this and I'll forget everything, but I'll just say, when you get a chance sometime today or this weekend, check out SheridanMentoring.com. We have our 3K class starting, our May class starting Tuesday. That's a plan to make 3K and 25K. We've been doing it since June, and we've been doing it through every up month, down month, whatever the market throws at us. We put on live trades and go through it. I think it'd be a great opportunity for you to learn the craft and to have your hand held as you go through these trades and see how we make decisions. It's been a great class. Couple months as the market was really going down, we broke even. Every other month we've made money, and I think it'll be a great opportunity for you. The other thing that's coming up next week, you get information on our site. The other thing coming up, not next week, but the week after, we're going to go back to live online classes. I'm going to do one on iron condors, more in a volatile market. I think that'll be a big help to you. You know, 3 or 4 different tweaks that I've incorporated in these iron condors, and those will be a couple of very helpful classes for you. Now, let's jump in here. So when I asked that question to all of you, how's trading going, right? Even, you know, and there were many answers, which is good, but I don't know what that means to you. But I will tell you this, everything that was going on in your mind, or when you said good, bad, ugly, whatever, falls into three pieces of pie, right? For an options portfolio, I look at number 1 would be spec, right? That to me would be the smallest part of the portfolio. But this is spec. How many, when I describe spec, tell me that's what I meant when I was saying about trading. Spec is, I have an opinion, you know, maybe 1 day to 3 months or something. I have an opinion based on charts, fundamentals, late night pizza, swing trading, you know, whatever. I'm going to buy calls or puts, buy verticals, spec, betting on a direction short term, playing the swings of the market like we've had. Who, when they mention how trading's going, that's what they're talking about, spec directional, right? Yeah, and it could be like Chris said, spec directional buying pullbacks and uptrends and selling rips. That's a good word, in downtrends. Yeah, so that's spec. And again, you know, for me or people in our community, you know, this might be 10 to 15% in normal times, but in more volatile times like this, where you got a lot of movement, you know, it might go up to 30%, right? But, you know, there's risk to that. That's spec. And then the other part of the portfolio, I call it long portfolio. That would be taking more a medium to longer term perspective. That would be where, hey, long stock, and stocks you like, long ETFs, long or covered rights, cash secured puts, long diagonals, which is like a poor man's covered right, wide put credit spreads and stocks you like, or something like that. How many? So first question is, in the spec part of the portfolio, how many have been doing some stuff that would be considered spec in the last couple of weeks? calls, puts, vertical spreads. Could be buying stock short term, you know. All right, and that's one part. How many have been doing long portfolio? And this would be, hey, I'm starting to dip my toes buying stock and some stocks or anything, but you're looking more long, a little bit longer term. Hey, I think Microsoft will be higher in 6 months or a year. I'll buy some stock or I'll buy some options or do a covered right or so. And so you're doing that. And normally we might allocate 30 to 40% in that. And with the market SPX down, what are we down about 16% off the highs of January 4th? So in terms of what you might be doing now, you know, if some people are looking long term, this might be 30 to 40%. You know, if you feel, hey, this is how many have been dipping their toes into buying stocks or doing covered rights or long diagonals in stocks that they really like over the next year or two? How many have been dipping their toes in that? And that's called long portfolio. And then the third part of the portfolio, which we do a lot of, is range bound, or we'll call it income, even though they're all for income, right? Income. And we're normally close to 50% of your allocation in that. What do you think we're doing now as of today in the range bound? If this is our normal, what do you think we're doing today? Take a guess. In the Sheridan Mentoring, take a guess. What do you think we're doing? If we're normally, these are our normal allocations. These might be somebody's allocations now, right? But what do you think we'd be doing if we're normally 50%? Take a guess what our percentage is now. Take a guess. All right. Richard hit it. As of now, remember, I said today. You with me? Today, if you ask me what's the allocation, I put 10%. Did you know in the title of this, I gave you the answer. In a range bound market, who on planet Earth, right, could look at this and say, hey, Dan, this is a range bound? Who, let me say that again in Spanish. Who on planet Earth can look at this and say, this is range bound? Anybody? Is there anybody there? So why would you expect 40 to 30%? Now you say, oh, what's your answer? Why? I know your next answer. If I said, why would you have thought 40 or 30%? What would you say? Because what? What would be a case for doing more range bound now? What would be a case for doing more range bound like iron condors, calendar, butterflies, etc. now? What would be a reason? No, say high what? High VIX is 30 right now. Do you know the range over the last 2 months? The last 2 months, the range is about 20 to whatever, 35, 36. So are we in the higher end of the range in VIX? Are we in the higher end of the range as I defined it in VIX? What do you think? Are we relatively in the higher end of the range in VIX? Yes. So, and if you believe in reversion to mean, right, you would do that. But again, even in a high volatility environment, if you're doing range bound, don't you still want some type of range or some two-way, right? So even if the volatilities are high, I still want some type of two-way or range bound. Does that make sense? Why we don't just go in a high volatility and say, sell it? Does that make sense? Right? Yes? Please say yes. Thank you. Now, so, a couple of things I like to see. Here's something called the ATR. ATR means average true range, and it takes, if you look at the SPX today, here's the high, here's the low, here's where we're at now. So what is the range? The range is about, roughly 80 points. So the ATR measures the distance between the high and the low, and you can see as the market's been going down over the last month, ATR has been going up. That distance between the high and the low has been consistently 80, 100 or more. Do you think that's good or bad for a range-bound trader? When the ATR, when the range is bad. So what I'm saying is for range-bound traders, we're probably in 80 to 85% of the time. I think this 4 months is an exception, but I think there's easy criteria to see when the waves are getting too higher. I think John Crow made a good statement. For me, the ATR over 100 is what's tough. Yeah, it is. And I'm going to comment on that. And we're using this in Thinkorswim, or it's a short term. This is a 14-day. Normally we use a 9-day. Now, if you wanted to help John Crow, someone help me with his statement. He said, for me, the ATR over 100, having a wide range, is tough. I have to adjust every day. What one tweak could you tell John that would cut down on his adjustments if he was going to do some range bound? In a turbulent environment, what's one thing that you could make range bound trades much more palatable? It's called, as Chris said, duration, right? Duration. Let me say it in Swedish. Duration. The further you go out in time, the less the price risk will bite you in the fanny. The closer you come in time, when we have a move, the quicker you'll be bit in the fanny, right? All right. So to me, I struggle with patience. How many of you struggle with patience? You take a shower in the morning, you have a good breakfast, and so you feel, hey, you put on your favorite music, let's roll, right? Trading isn't like a construction job, agree? Construction job in downtown Chicago, you take a shower, you have a good breakfast, you had a good rest the previous night, you're going to work, you feel good, you'll work well. The best move you can do in trading sometimes is do nothing, right? And in the range bound stuff, if you can make money most months, and when the waves get too high, stay on the sidelines, you'll be in good shape, right? And so patience is, part of good patience is having a plan. Anyways, let's whip through some strategies just to give you an idea. Some of it may be new to you. If you like what we're talking about, again, I would encourage you. The 3K class would be wonderful for you next week. We give you 2 hours. We have literally an hour for beginners, and then we have the more medium advanced an hour. So I have 2 hours each day, Tuesday and Thursday for 4 weeks for you. and then the iron condor will be the week after. So a couple strategies. And again, we'd be very light right now, right? No matter what the volatility is, because with range bound, do we need more than a day and a half of up moves before we see some stability? Yes or no? Do we need more than a day of it? Yeah, right? I mean, even look at today, right? We had a class in Sheridan Mentoring, and so far I'm the worst. Don't ever listen to Dan about technicals, but I'm going to tell you this. So we did this earlier in the day in one of our sessions in Sheridan Mentoring, and this is when we were at, I think we were near the highs, like 40.25 or 40.30, and I said, hey, by the end of the day, where do you think we'll close today? Right? And Mark Fenton, the other mentor, he said 39.70, and he's getting there. Most of the folk in the class, John Crow, Kevin Shea, and others, they were all around 4,000, 4,010, which still may hit it, right? I was contrarian, right? My contrarian, because everybody thought it would come down some. I said 40.50. So it looks like Dan is going to be the worst one on that one. And we'll see what happens here the rest of the day. But let's look at a few strategies. So these would be strategies that I would be comfortable with small size in this market. Is that understood? Is that understood what I'm saying? And I'll explain to you. But again, I can't show you that SPX chart enough. If you go in and put some good capital and range bound trades, I'm going to say it in 4 different languages. Shame on you, right? Let me say it again. Shame, shame, shame on you. I'm not saying you couldn't, the market couldn't make money, but I'm saying generally, when you look at a chart like this, this is what's driving my decision. The activity over the last, I'm making my decision on trading over the last couple months, right? So if you can say that's good range bound, maybe you're on a different planet, right? Does that make sense? All right. So let's move on. So trade number 1, I'm going to start with a put credit spread. With me? And let me adjust this a little bit because the market has actually gone down. And I'll give you just some quick thoughts on this. I can't go extensive into every strategy or we wouldn't finish. But let me just give you my 2 cents here. We've dropped quite a bit since I modeled these. All right, here's a put credit spread in SPS. How many have done put credit spreads? How many have done put credit spreads? Now, so there's 2 or 3 advantages of doing put credit spreads in SPX or other vehicles, but SPX, when the VIX is high. There's 3 advantages. Number 1, you get a bigger credit. How many are aware that you get a bigger credit on put credit spreads when VIX is higher, at least in SPX? You get a bigger credit than you normally do when it's lower. Second thing you get is a lot more room. Your short put will be, I'll just put much more room, but your short put is a lot further out of the money. And the third thing is, when you look at your position deltas and the current price in SPX, when the VIX goes up, especially as you get over 30, you're less long deltas, right? Less long deltas. And why is that an advantage? Because this already is a strategy that has no risk on the upside. Right? And plenty of room on the downside, but now, if the VIX were 10 points lower, a 10 wide put credit spread might be 1.5 deltas long. You're less long delta, so you have less exposure on the downside. So those are some benefits. So with this example, I've got to go quick here, but I'll just give you some information. Here's where we're at right now, 39.87. I apologize if some of you aren't familiar with Thinkorswim. This is your graph at expiration. Right now, I'm using July 15, which is about 60 days out. Why do you think I'm going so far out on a put credit spread in this particular one? And my short is 35.90. Why do you think I'm going so far out of the money? Why do you think? Why am I going out 60 days? I could go 30, but why 60? Just to make a point. I have no problem with 30. Why? Anybody? Hello? Hello, hello, hello to you, hello to you, hello to you. Why am I going so far out of the money? It's the answer. How many of you are aware that we're in a very, very volatile environment? How many are aware of that? So if you're in a volatile environment, how do you get price protection? Duration, duration, duration. That's how, right? Protection, right? So that's why. So here's an example. It's a 10 wide credit spread. I'm selling the 35.90 puts with us almost at 4,000. So it's like if I'm in Florida, I'm selling puts in Minnesota, right? You got a lot of room here, right? You bring in a credit of dollar, let's say $1.60 credit. Your risk is the difference in strikes, 1,000 less your credit, about $840 of marginal risk. Now, your theta is not great with this type of trade, but this is not only do you get good price protection, but if VIX decreases and reverts to the mean, is that good for this? If volatilities decrease, VIX decreases, goes from 30 to 3, it's very good. So this is something that I'd be comfortable with a credit spread, put credit spread. And with the market down 17%, and I don't have an opportunity to get into a lot of risk management today, but I'll just say, in the 3K class, when we go over it, we'll do some credit spreads, talk about risk management, but I'll just say this risk management. If I'm looking, here's the basic principle. If you're trying to make 10% on this credit spread, which would be, if this is my margin of risk, I'm trying to make about 10%, that's $80, right? So if the credit is 160, and I'm trying to make 10%, I'd sell it at 160, buy it back for 80-cent debit, right? I buy it back for 80-cent debit, and I sell it for 160 credit. I'd make $80 divided by 840, about 10%. But the main principle with these trades is this, and this is like beginning risk management. If you're trading consistently on good probability type trades, good trades, I'll call it, and you're winning a lot more than you're losing, and you're keeping your losers under control, you'll do well. So I like doing a probability trade like a put credit spread. I say I don't want to lose more than 15%. 15% of 840, I'm just rounding this, somewhere around 120 bucks. So if this 160 goes to 280 or higher, you get out, right? It's called risk management, right? Anyways, that's a put credit spread. Now, let's move from the put credit spread. And again, when something, to me, range bound or delta neutral in SPX might be, I'm between 0 and 2 deltas long or short. Even though this is a little bit directional, could you say that a half a delta long is pretty non-directional? Yes or no? A half a delta long, is that really directional? So it isn't really. I mean, to me, I would put that in the range bound. No. So I'm going to put that in the range bound part of the portfolio or long portfolio. Let's switch and let's move back real quick. How many of you think we're in a downtrend? How many of you think we're in a downtrend? Of course we are, right? We're below, if you look at a chart, we're below the 200-day moving average. We're below the 50-day moving average. We're below a 9-day exponential moving average. We are in a downtrend, right? And we're down what? 16, 17% off the GM. So on rallies here, is it a good idea? How many have been doing call credit spreads? Our call credit spreads may be a good directional trade to play on rallies. What do you think? Yes or no? Yeah. But how many of you get a little concerned with call credit spreads that, how many aren't good at picking the top? Like, in other words, we go up to the call credit spread. How many of you do call credit spreads and generally when you put it on, the market continues to go up? If I could type in the chat, I would put me first, right? How many of you are good at picking tops? So let me give you an idea today. This is a butterfly trade, but this is what it is. Let me first set up the strikes. Because again, we've moved. Now, this, I'm going from a 60-day trade. Now I'm going to go to a June 10th. Let me show you something. 28 days out. June 10th, 28 days out. June 10th, June 10th, 28 days out. And just a second. Okay. So would everybody agree this is a call? So let's start with this piece. If I do this, sell one, buy one, and we're going in June 10th. So this is about 28 days out. And I sell a 42.30 call. And I buy a 42.50 call. Is everybody familiar with that, what that is? What do you call that? What do you guys in your vernacular call that? Sell one 42.30 call in SPX, buy one 42.50. What do you call that? Call credit spread? It's not a bull call, right? If you're selling the 42.30, buying the 42.50, we want it to go down. Bear call, right? We could call it a call credit spread. It's a vertical spread, right? And everybody understands want it to go down. But, so I'm going to give you a little, make things a little more complicated today, but I didn't mean to. But, so, if you do that, how many people are a little nervous that, hey, it could go up more? So, a way to say, to not lean as much on the downside would be to take this piece, right? And then add on top of it this. You with me? So this is piece number one. Everybody recognize, and what's the width of this call credit spread? What's the width of this bear call spread? 20. So if I add on to this, number two, buy one 42.20 call, sell one 42.30. In your vernacular, what would you call this spread? What would you guys call this, and ladies? What do you call that? What do you call that? Buy one 42.20 call, sell one 42.30. That's going to be called a bull call spread. Remember, if you're going to say a credit spread in the calls, credit spread in the calls, you're going to sell the higher strike, or sell the, excuse me, a credit spread in the calls, you're going to sell the lower strike by the higher strike. A bull call spread or a debit spread in the calls, you're going to buy the lower strike, sell the higher strike. Now, what's the width of this spread? What's the width of this spread? 10. So if I combine both of this, here's what I'm left with, and this is what I'm going to show you. This is basically saying I've got a 20 wide call credit spread, but I'd like to get it's still in a call credit spread, you have no risk on the downside, some risk on the upside. By doing this, you're just you're giving up some of your potential profit on the downside to cut your risk on the upside by half. Is that okay for a citizen of the United States to make? If they don't want the risk of a call credit spread, is that okay for someone in the US to say, you know what, I'm willing to give up some of my downside profit to reduce my upside risk in half? And so what you're left with is something called just a broken wing butterfly. So if I combine these two, all it is this. I'm just combining the two pieces I told you. So here you could have, what I have is one 20 wide call credit spread and one 10 wide call debit spread. And what that does is, it cuts the sting out. What does that mean? It cuts the sting out. It reduces my downside potential some, but I still make money. But I want less risk on the upside, right? Called a broken wing, called butterfly, buy one, sell two, buy one. But you can see the widths are different. The width between this long and short is 10. The width between this long and short is 20. And ultimately what it looks like is this. Right? So this is the underlying. $39.97. Right? So the capital that I'm putting up with this trade, let's take a look at this. The capital I'm putting up with this trade is $800. And I'm bringing in a credit of about $2. $200. Is that a good return? Is that a good potential return? And Sylvester Stallone would say absolutely. Right? So the yields are good. We still have good downside risk or downside profit, no risk on the downside. But we've cut the upside risk up by buying a bit by buying the debit spread. So it's really just a debit spread on top of the credit spread. Right? How many of you, this is the first time you've heard of something like this? A debit spread on top of a credit spread. Who was your first time hearing about this? Anyways, now, as always, I have more on that I want to cover. A butterfly and iron condor. I think I should just cut it off. Richard says you put your shorts 200 above the money. My shorts, Richard, in this case, were about 230 points above the money. I sold my short strike, Richard, like a 20 delta. That's what I did in this particular case. But if you'd like to learn more about this type of trading, I'll cover iron condors and butterflies also next time. I encourage you, jump in on the 3K class. You'll learn a ton. And the nice thing is, every class I'm putting on 1 or 2 live trades, whatever the market throws at us the next 4 weeks. You'll have a lot of fun. Then you can get information on our website. If you have any other questions on anything, you can email me, dan@sheridanmentoring.com. And we'll cover some more things next time. Have a nice weekend, everybody. And we'll see you later. Thank you.